Hello everyone, welcome back to EQSIS. In this video, I'll be explaining you the simplest trick to understand the likely market direction for a given expiry. I'll be performing this by using option chain analysis. And even if you have a basic understanding of options, you will be in the position to understand and implement. I'll be explaining it as well as I'll give you some exercise so that you can master this trick. Let me quickly get into this. To perform this analysis, all you need is a basic option chain table along with the strategy builder. Such tools are freely available across web, but if you want the simplest one, I recommend you go to EQSIS. Just go to Google and search it. And the very first link takes you through a home page. There you see an application. Underneath you see EQSIS Primer. It is a research platform. There you see a research tools, option strategy builder, create strategy. So here you see two important components. The first one gives you the simple option chain table along with strike price where you can simulate by buying and selling. And the right hand side, it gives you the charts by which we can understand the payoff. To explain you the concept, I'll be using Nifty 50 option chain. But to give you a live example, I'll be performing this on Bank Nifty this month expiry so that we get an understanding where exactly market is heading for this month using this trick. And then I'll be giving you a few exercises for you to repeat it to gain the confidence. See, before I get into data analysis, let me first explain you the logic and thought process behind the whole concept. Imagine if you and me were a buyer, we tend to pay different price to the different asset. And it is very natural that we tend to pay more to the assets that we like, and we tend to pay less or we don't pay for the assets that we don't like. But imagine if it is a group of people chasing a list of products, then there is a competition comes into the picture. That's where the market comes into the picture. So if you look at the price, it has its own story to reveal whether the people are liking it or not. That's the underlying concept. Let me explain this along with call options and put options. For that, you need to have a basic understanding of options that is necessary. I mean, if people are chasing, if the traders are chasing the call options and willing to pay more, and if you tend to see more premium, then the underlying market expectation is bullish. And if you see people are chasing the put options and people are pricing put options at a higher note, then the underlying market expectation is bearish. Remember, just by having a more premium doesn't mean you go and buy. But it is true that market expectation is bullish. But sometimes if it is overly priced, then the market tends to correct it. Or if it is underpriced, then it is an opportunity to buy. So there is a contra thought along with it. So understand the first note of the concept that market has reasons to go for it. And if it is irrational, we need to know how to differentiate it. Let me give you an example here. If you look at a 24,800 that is highlighted as at the money strike price, referring to Nifty 50 charts here, 24,750. So ideally 24,750 happens to be the at the money, but this particular tool highlights 24,800 as at the money because the at the money can be referred not by using the spot price alone. We can even use the future price. But Nifty 50, we don't have a weekly futures. Rather, we have only monthly futures. Am I right? So there is one smart way to understand the indicative future price for a given weekly expiry is you buy any strike price call option and sell a same strike price put option. Then you figure out the break-even point that shows a indicative future price. We call it as a synthetic future, okay, which is buying a call and selling a put in a way that you see a payoff chart behavior of future that shows 24,770. Why I'm explaining to you this concept? Look at this, without understanding this break even, many people make a poor judgment using option chain analysis. What they do is they'll take that 24,800 call option price is 194 and put option price is 217, and they compare with 194 and 217. Considering this as at the money, they say put option is overly priced. That's a mistake is what I'm trying to convey here. And correspondingly, even if you take 24,750, there the call option price is 217, put option price is 193. Considering that, and if you make a judgment, a call option is more. That's a mistake because the indicative future price is actually right in between, which is 24,777. It means this call option, this 24,750 call option is comparable because it is 25 rupees in the money basically. Okay, because market is 24,775, so it is 25 rupees in the money. With the put option, 24,800 put option is quite good to compare with 24,750 call option, because this is also 25 rupees in the money. So that is the reason why you see 24,750 call option and 24,800 put options having a very similar premium, because both are in the money to the greater extent. So this is what called as apple to apple comparison. Don't make a wild comparison with this particular call option premium with this particular one. That's a very poor understanding, without understanding the how much in the money it is already within the at the money. Okay, coming back to the concept, what I'm going to explain to you is, let's say now market is 24,750, and we are buying 24,750 call option. Okay, and we are paying 219 rupees premium. Okay, and I want to understand where exactly the market is heading to. Is market is heading bullish or is market is heading bearish, right? To understand that, I'm trying to nullify the premium. The concept of nullifying the premium is 24,750 call option that I'm paying 219. I wish to take the whole premium back. It means I wish to take this 25,000 call option. I'm selling this into two lots. So one hand I'm paying 219 from a packet. On the other hand, I'm receiving 118 into 2, which is close to 218 that I'm getting it back. So the net premium what I pay to this particular strategy is close to zero. In this case, only about 8 rupees is what we have. So that's the credit risk that we have on the market downside. So what exactly this strategy says? See, this is a credit spread, or I can say no spread strategy. But on the bullish note, you make money, but on a bearish note, you don't lose anything. But for you to truly lose money, this strategy needs to break even at at 25,258. So remember, 25,258 is a place where you start losing money. So if market is if market is extremely bullish, you won't be getting such area. Rather, like, you will have a a kind of a shorter a break even point, because if market is extremely bullish, you tend to lose that particular losses. So now look at this with the put options here, the same 250 points on the downside. Okay, so what I'm doing is, on one hand I'm paying 193, I'm trying to collect that entire premium back here. Logically, you can even do this way to understand this, because of that in the money adjustment. Look at this. It is actually giving you, there we got about 8 rupees as a credit spread. Here we are not getting any credit. So this actually says that the market is willing to pay slightly more on a call option, but on a put option it is not paying, but the difference is not big. But let me now show you an example with respect to Bank Nifty that has some clear difference, so that we can understand where the market is heading to for this particular month. So let me get into Bank Nifty here. Okay. So once you get into Bank Nifty, you have Bank Nifty option chain here. And Bank Nifty is now 55,749, and at the money is, the indicative at the money is trading at 56,100. I think you don't have to worry too much about it, because if you again take call options and sell options, then you take 56,094 is at the money. Otherwise, Bank Nifty, you can refer Bank Nifty future itself to take that particular price for the true at the money indication. Don't take spot price, because spot price has its own cost to carry involved. So better take a future price as an indicator for at the money. Coming back to this, if I want to nullify the whole premium, I'm buying 56,100 and I'm selling corresponding things to right of this. So if I want to sell this into two lots, okay, or if I want to cover this about 1000 points, let's say, okay, if I want to cover this for about 1000 points, it means this particular 1000 points movement, am I right, gives my whole premium back along with 86 rupees, Whereas if I go for a put option for a same 1000 points movement, and if I cover the whole premium, it is giving me 166. So market is not giving much cushion for me on the upside, but market is giving me lot of cushion on the downside. Are you getting this particular one? On the upside, I'm not getting a much cushion, but on the downside, I'm getting a more cushion. So if I want to make this, probably I can even have 1100 points to get even 101. So I'll be having, look at the break even here. This break even will be close to 2200 points away from the current price. So market, if I form a bearish strategy, market is giving me a better risk reward than on the upside. So market is saying that if you want, you go and form a bearish strategy, because we are thinking about the upside, because on upside we are not getting enough premium, but on the downside we are getting a good premium. So the market expectation for this particular month is slightly on the positive note, because the call options we are not getting enough premium as a buyer to nullify. So it's very smart to understand that a market expectation is slightly bullish on this note. So I've given you a fair idea about what it is, but if you need more detailed explanation about it, I think it deserves a tutorial even. But if you want it, do express your expectations in the comment and which part that you want more detail, then I'll be explaining you this. But here is a task that I wish to give it to you. Do not apply this on illiquid companies, because it can indicate a wrong numbers to it. Don't go far out of the money which are actually liquid with respect to active contracts even. So I recommend you try this on Reliance, try this on ICICI, try this on TCS, and give us your comment. And this is not necessarily you can do it only now. This kind of exercise, any point in time you see this particular video, you can try them and get an understanding. But I recommend this analysis to be done at the first 10 days to get a fair understanding about it. But logically speaking, this logic is quite applicable even on the expiry date. So right from day one till the expiry day, anytime you can apply this, but all you need is a liquidity, and fair pricing and competitive pricing should be there on this particular concept. I hope you understood the whole logic about it.